I guess we're going to be more than prompt. All right, Andrew, I think you're up.
All right. Welcome, everybody, to today's webinar, the $2 billion Burrito, a deep dive into Pershing Square's Chipotle investment. My name is Andrew Carr. I'm here together with Paul Johnson, director of the Wharton Wall Street Prep Applied Value Investing Certificate Program. And today we're going to walk through, from an applied value investing lens, the drivers of what we infer to be Pershing Square's investment philosophy in getting involved in Chipotle. Got a great setup. A couple other things before we kick things off and I hand it over to Paul. We will be launching the Applied Value Investing Program on February 10th. It runs through, I believe, April 6th. And further to that, we have plans for an event in Omaha in the works. More details on that will be forthcoming. And also, because we get a lot of questions on this, a recording will be made available within, I think, 24 hours afterward. So now that the introductory boilerplate language is out of the way, I'm going to hand the mic over to Paul so he can walk us through the investment. Over to you, Paul.
Thank you, Andrew. I just want to reiterate a couple things Andrew said that those of you who know me at all know the opportunity to talk on a webinar is near and dear to my heart. I do them every week, although they're a lot of work. But this is in conjunction with the Applied Value Investing Certificate Program that we're launching on February 10th in conjunction with Wall Street Prep and the Wharton School. So although I like doing this, it is very much directed towards giving people information and really a taste of the kinds of tools that we're going to show in that certificate program. And as Andrew said, I've not had a chance to talk to Bill Ackman about his investment, but I'm using kind of my lens, our tools that we've developed as a way to kind of infer what he saw in the investment. So I'm going to talk a bunch about Chipotle. I think most people know what it is, so I won't belabor the business model at all, but I'll talk about it from an applied value investing perspective, and then interlace with that the Pershing Square investment. All right, I've got all kinds of notifications from, well, sorry about that. My computer is asking all kinds of questions. All right, so let's just jump in as we were. This has been a big stock. Any of you that have followed it know that this is a 10-year chart. If you go back, this stock, they did a reverse split, sorry, recently. So it used to be a much higher price per share, but now there are more shares, obviously. This is a share adjusted stock price, of course. But if you go back 8 or so years ago, really when Pershing Square got involved, the stock was below 10, and it's traded as high as almost 70 recently, and it's in the high 50s right now. So anyway, you think about it, this has been a monster stock and a really terrific investment for Pershing Square. I want to walk you through my take on what I think they sort of saw. Big stock. It got announced that Pershing Square had bought nearly 10%, 9.9% of Chipotle. It got announced on September 7, 2016, so 8+ years ago. And it's been a really terrific investment for Bill. Although as I got into, I've been following Chipotle for a long time, but as I got into the Ackman trade, it's more sophisticated than I had originally thought, which we'll get to. All right, and so this is where you see that Ackman bought. This is right at the end of 16, and his from price to price, it's up 6-fold. But as you'll see, he trimmed the position pretty consistently over those 8 years, that was the part that was kind of fascinating to see. The stock, obviously, since he owned his first share, is up over 600%, which is pretty impressive. Now, when you start to look at a 2-year chart and a 1-year chart, and we're about to toggle back and forth, the stock has definitely, certainly this year, been much more of a sideways move. And I think that's related to kind of 2 things. One, the CEO Brian Nichols resigning. I'll talk about that momentarily. And two, the growth in the company's growth rate has definitely been inconsistent over the last 4 or 5 quarters. I'll highlight that as well. And I think that's added a lot of volatility and turbulence to the stock. So, you know, on a 10-year basis, this has been a monster stock. On a 2-year basis, still a very good stock. It's gone from, you know, lows of 30 to above 60. So it's been a double in the last 2 years. But over the last year, it's definitely shown a much different trading pattern. And I think the fundamentals, when we get to the fundamentals, we'll be able to explain some of that, right? Maybe all of it. All right. So the most important event of last year was certainly Brian Nichols stepping down. And this is important. Without a question, Brian was the driver of the renewed financial performance from the company. And that's not to say that the new CEO and COO aren't going to be able to continue it, but I think Brian leaving is a very interesting comment. He's going to Starbucks, given his experience and successes. It's kind of the next big whale to take on. I don't know much about Starbucks, but it looks like it's probably a pretty good marriage. I'm sure there are people on this call that know much more than I do. But there are some challenges for the new management team that are, and I'll go through, that are not insignificant. And I don't want to read into this that Brian thought that Chipotle was no longer a good stock or a good company to ride. I think it was probably more pulled to the opportunity to turn around an iconic brand like Starbucks. But the fact he left is really important because he was, without a question, captain of the ship and execute. As you'll see, the numbers are really quite terrific, quite impressive. All right, everybody knows what Chipotle does, but just to walk through it, they sell food. They are a quick serve restaurant called fast casual, the higher end pricing of the quick serve market. They kind of invented this model, which is an assembly line of food. I don't want to, it's quite delicious. They do an excellent job. It's very fresh, very clean, very transparent on the ingredients. And so they really invented this approach. Many other companies have come along with a similar idea. All of the salad bars, Dig In, which I think is now called Dig, all the poke shops and things like that have followed this same idea, giving the consumer a choice down the line. I sat down, this is from many years ago, I tried to figure out how many different combinations of burritos you could make. When I go to Chipotle with my son, we have almost the exact opposite. It's kind of funny to see. But there are over 5,000 unique combinations, which is, I think, incredibly powerful as a model. And the original Chipotle idea, I think, was something that was a genius because you've got all these unique combinations. So I think most people get a very similar burrito or bowl when they go, but you have the option to add variety. And a lot of people like variety with their meals. So the freshness of it, the customization of it, the fact that it's built right there for you, it was really brilliant. But the challenge, of course, and I think most people know that, is that you're dealing with food and organic and fresh food, and ultimately food safety is a critical issue. And in 2015, they had that challenge. I'll show you some charts and things related to it. All right. I think it's important to realize that Chipotle's primary competitor is things like Panera rather than Taco Bell. That doesn't mean that people that eat at Chipotle don't eat at Taco Bell, but that high-end casual market is really Panera, Dig In, the salad places, and things like that. So just important to keep that in mind when you analyze a company like Chipotle. All right, so here is the valuation summary. I'm going to annotate this momentarily, but just walk people through the table. This is the valuation summary table I use for all my companies. Essentially, what we're looking at is a historical valuation. A couple of things are important. Fiscal year, that's the line with the dates. Chipotle's easy. They have a December fiscal year. In the program, our case study is going to be Steelcase. They have a February fiscal year, so it's a tad bit more more confusing. All right, here's a couple things that are key and that will be important later in the case. What I do is, and this is the share price row, is that's the price of the stock the day after the company reports their fiscal results for that year. So for fiscal 2014, the company reported their results on February 4th, 2015. The 1342 is the stock price on the close of business the next day, the 5th of February. Here's the logic. The company reports their financial results at the end of the day, February 4th, 2015. The next day, that information is digested into the market. Investors then vote, reassess their sense of value, their estimate of value for the company. Then the stock closes on the 5th. That is one day after the news has been released. And then I do that every year. So in the next year, fiscal 2015, December of 2015, gets reported on the 2nd of February. On the 3rd of February, the stock closes. This is a split adjusted 924. And we go all the way through that way. And you'll see in a minute why that's important. And then we can calculate the market cap and calculate the enterprise value at that day. LTM, the one on the far right, is through the December quarter. I'm sorry, it's through the September quarter, and it's an LTM, so it's 12 months ended September. They haven't reported the year-end results, but when you look at the income statement and the balance sheet, that's through the 9 months. That's the most current publicly released financials, but I do price it at today's price. I priced it the other day as I was prepping the case. And so the current market cap is 79.5 billion. The current enterprise value is 82 billion. That's important. And you can see the trend that we've seen. Now, in 2015, November of 2015, the company announced that there had been an outbreak of norovirus in their food, a foodborne illness, affected 11 people, caused a bit of a scare that certainly affected demand the next year for the company's financials. You'll see that. And then in September of 2016, with the stock at a pretty significant low, Pershing Square makes their investment. And you can see that the enterprise value, this is going to track what we saw in the stock chart, but the enterprise value at the end of 2017, which is in early 18, goes from 7.4 billion to 82 billion, so a tenfold increase in the enterprise value. And that's the trade, which is extremely impressive on Pershing Square's point of view. All right, so here's your P&L. Again, this is just their fiscal year. Revenues, cost of goods sold, operating expenses down to net income. And then we look at margins. Now, in 2014, 2015, before norovirus, this company was operating on all cylinders. It was really an impressive company and impressive financial performance. Their net income was just shy of 11%, and that was the high water mark. In 16, the year after the norovirus, was kind of break even. 2017 made a little bit more money, and then they slowly came back. And then, of course, we all lived through COVID. They actually did very, very well in COVID. They stayed open, and it was an alternative. A lot of restaurants closed, and it was an alternative to staying at home. So they did quite well in COVID. It's very impressive. And again, Bill bought in when the company in 2016 was not making money, was essentially break even. And I would argue that his bet is that this Brian Nichols, a very impressive CEO, would be able to get the foodborne illness behind them and get people back into a Chipotle. And that it was a business that's got scale. We'll talk about that in a few slides. And I think that what Pershing made a bet, pretty simple bet, but by the way, he was one of the few people to make it. So I don't mean to make it was simple and obvious, but it was a fairly simple bet that people would come back to Chipotle and that they'd be able to go back to growing the number of restaurants, the number of units, and people would come back. I think that was the fundamental bet, that it was inherently a good business with a great management team. And he, I think, proved to be right. Now, if we look at profitability now, net income versus in 14, 15 is actually higher. It's 4 It's 4 percentage points higher, 400 basis points higher, 300 basis points higher, which is very impressive. But if you go look on an operating profit basis, it's actually the same. They're back now to that 17, a little bit over 17%. And I think that's really what Bill saw. He saw that that was the potential. It would take a little while, but that's the advantage of value investing, is you can actually hold on to positions for a long time. This has proved very well. So not only has the company grown its revenues, but it's increased its profitability. So the big difference between the net income percentage and the operating percentage is taxes. As you all know, in the first term of President Trump, he cut the statutory rate. And so the difference in net income versus 2014-15 is really taxes, because as you saw, the operating income is back to where it was. Now, what's really interesting in my mind is that the gross margin is actually significantly higher than what it was. And that's been driven mostly by pricing. The company's done an excellent job, and it shows their power as a call it a brand. They've been able to drive pricing up, not just pricing per, but also guacamole and adding a few other things that are an add-on as added to the average ticket price. Certainly, I think that one of the things that Brian Nichols realized is that the product was underpriced. Chipotle had a history of not raising prices. And one of his options was that the meal was underpriced versus his direct competitors, and they slowly implemented that. So a really terrific job. But the counterbalance to that has been safety, food-related safety. Prior to the norovirus, the company was notorious for not having aggressive safety, food safety procedures in place. And after norovirus, they had to implement that. And that increased their operating expenses a fair amount. The company's been able to offset that with higher prices and a better mix. But to get to the point where operating income is now back to where it was. Now, it does beg the question is, and as you look forward in stocks, and all stocks look forward, is do they have much more room in either pricing or in profitability? And that's something people are going to have to grapple with. I'll give you some thoughts later in the presentation, but that's really one of the issues you have to talk to. All right, so the summary is that operating profitability is back to when they were a high-flying young company. You got to tip your hand in the management team. They've executed unbelievably well on that issue. You've seen a bit of a mix between higher selling prices, higher gross margin, and higher safety features throughout the business. And then you have you have significantly higher net income, but that's all because of lower taxes. All right, terrific. All right, so let's go look at return on capital. Anybody that's spent any time with me know this is my favorite measure. It's really important. I want to just make one comment that this NOPAT, I use NOPAT to drive my return on invested capital. It's a cleaned up net income. I've really used NOPAT for, I don't know, 20 plus years, probably more now, 25 years. And it's just, as I said, I think the best measure of the economic profit of a business. If you want to learn more about NOPAT, there's a million things on the web, or you can enroll in the program, and we'll talk a bit about it. The return on capital for this company is very impressive, and they've done an outstanding job over the years. We go back to 14, 15, really the golden years in Chipotle's life, although not the best food safety record, was in the 25 to 27%. In 2019, they had to bring all the leases onto their balance sheet, so that was a one-time hit to return on capital. But you're now back to 24% on an LTM basis. This is an extremely well-run company with great returns. Now, anytime a company has high return on capital, you have to ask yourself kind of two things. What's the source of that excess return, and are they sustainable? And in Chipotle's case, I think they are sustainable, but I want to walk through the sources, if you will. But what you've seen is that the return on capital has gone from 4.6% to 24%. As a general rule for companies, not always true, that when the return on capital increases like this, it is almost always leads to an increase in the stock. Now, the challenge, of course, for Chipotle is growth, and we'll get to that. But when you see something like this, that's very impressive, extremely important metric to monitor and watch. And we're close. We're close. I think it may be harder to get to that 25, 27% just because the leases are on the balance sheet, whereas before they were not. All right, now the return on invested capital can be broken into two primary metrics. One is an operating margin, and the other one is scale. And what you see in Chipotle's case, really because of the leases, their scale will not, I don't think it'll get back to where it used to be. If you look back to pre-leases, they were in the 2.5 times, which is very impressive for an operating company. And the real story here has been operating margins, percentage margins. So you've seen them go from a low in 2020 of 3.8% to recently 14.8%, which is an all-time high for the company as a public company. That's really what's driven that return on capital. Here are those same metrics graphed, and you can just see that return on capital continues to expand very impressively. Scale has come up a bit, but the real driver has been that NOPAT margin. All right, so sources of excess returns, there is really only 3. There's technically 4 of government policy, but that's rare and unusual. But there's really 3. First one is a demand side competitive advantage, in that your customers are willing to pay a higher price than they would in a competitive market. That ends up being customer captivity. It's really a customer-facing advantage. It's an external advantage. We'll talk about these for Chipotle momentarily. I just want to set them up. So higher prices, and it comes from search, switching, or habit. Obviously, in Chipotle's case, there's neither a search nor a switching cost. So if they have a consumer side advantage, it would have to come from habit. The next source is a supply side, which is lower operating costs than your competitors. That's an internally facing competitive advantage. Really comes from proprietary technology, lower cost of inputs, or some sort of form of distribution. I'll argue that Chipotle doesn't really have any of that. And then the last one is a more efficient use of scale, and that comes from experience curve, economies of scale, or a platform company. So let's talk about Chipotle, customer captivity, production, or scale. On the customer captivity, I do think they have some level of habit, which is really preference, not habit. Think of habit as toothpaste or shampoo. This isn't so much habit as it is preference, which is relatively strong. I think they get a very high customer response to the quality of the food, the consistency of the food from visit to visit and location to location. Production side, I will argue they don't really have a sustainable competitive advantage. The model's fairly easy to replicate, as we have seen. The real competitive advantage for Chipotle is scale. And this always surprised people because they stop and say, well, what's the scale? Their density in any city and any state is pretty high, which means that getting fresh food to the Chipotle restaurants is fairly easy because they have enough restaurants that you have scale on that distribution into the network. Second place they have scale is advertising. And you see a lot of advertising for Chipotle. And because they have so many units in certain geographic areas, they can amortize or spread over all those units their marketing budget. So Chipotle's primary competitive advantage is actually scale. I know it's sort of funny to say, but I think that's true, with some level of customer preference. And that's a pretty powerful combination. Scale, because you really can earn excess returns. You also have some economic power against potential competitors. And then relatively happy customers. That to me is a very powerful combination. Well, a lot of people say, well, what about the Chipotle brand? I think that goes back to preference more than anything. It's certainly an easily identifiable brand, very well known. But I will argue that brand alone does not drive customer captivity. There's just too many examples of a strong brand not being able to drive customer captivity. So I would say the brand reinforces that preference, potentially encourages people to try the product, try the restaurant, but I'll come back to it. I think their primary competitive advantage is scale, and it's very, very strong scale with a touch of customer captivity. All right, now this is something that I refer to as the Italian cookie. This is the 3 layers of valuation that you see. The first layer is invested capital. The second layer is essentially earnings power value. The difference between earnings power value and invested capital is the present value of competitive advantage. That is the value that's driven by those excess returns. The third, if you will, is the enterprise value. The difference between enterprise value and earnings power value is the market implied value of NOPAT growth. That's what investors are paying for growth in the company. So these are your layers. Invested capital. Every company should be worth at least the capital that's invested in the business. If they earn excess returns, they're going to have excess returns in cash flow. That certainly has value. You add those two together, you get your earnings power value. Earnings power value is a steady state, no growth value, what the company would be worth if it never grew, but it maintained its NOPAT forever. And then enterprise value is effectively what investors are willing to pay for all future cash flows. And so if earnings power value is your steady state, no growth value, and enterprise value is the value of all cash flows, the difference between the two has to be growth. So that green layer is the market implied value of growth. The table on the lower left is just the LTM. You'll see it matches the upper right-hand corner, and you can see the percentage of enterprise value. So right now, Chipotle, 8.4% of their enterprise value is their invested capital. 20% of their invested cap, their enterprise value is earnings power value. 11.7% of their value is attributed to their excess returns. So we have an $82 billion enterprise value and a $16 billion earnings power value. The difference between those two is growth. So just shy of 80% of the current value is based on the company's growth into the future. So when you look at Chipotle and you look at it through this lens, the Italian cookie lens, you see that 80% of the value is growth. 80% of the future, 80% of current value is investors basically paying for future growth in NOPAT. And so, to some degree, the only thing that matters at Chipotle, if you own the stock over time, you have a longer time horizon, is growth. That's the only thing that matters. Now, other things drive that, of course, but growth is, an investor expectation for growth is the primary driver. And so we're going to have to talk about growth as we go forward. All right, there's your Italian cookie. All right, I just want to walk through this one more time. So enterprise value, we calculated that in the table above, easy. Earnings power value, you just take your NOPAT and divide it by 10% or your cost of capital. That's where you get earnings power value. Invested capital, you get right off the balance sheet. It's pretty straightforward. The present value competitive advantage, as I described, is your earnings power value minus your invested capital. And your market implied value growth is your enterprise value minus your EPV. So that's where we get all of the numbers. All right, so as of right now, earnings power value is 20% of the company's value. So the value of Chipotle, if they don't grow, but they maintain their current level of NOPAT, is $16.5 billion. However, if you buy the stock today, you're paying an enterprise value of $82 billion. So you're paying $65 billion for growth. So we got to go figure out if that makes sense or not. That's your market implied value growth at 10%. All right, so here's some charts. I'm very visual, and so I prefer the charts because I think it tells us a lot. So here's the company's enterprise value. I take that right from the Italian cookie table. And you can see that, I think I put this in, not yet, when Ackman bought in, the company had an enterprise value of, it was around $10 billion, and he's ridden that to $82 billion. That's the trade. Very, very impressive. All right, there's the full Italian cookie. You can just see it. This is the enterprise value. These are the slices of that enterprise value. I want to hone in on a couple of them. All right, so what was Ackman's bet? I think Ackman's bet was nothing more than the company would be able to grow its earnings power value. I think that was all that his bet was. So he buys 10%, the company's basically break even. And I think he believes that management team, very, very good management team, and basically a very good business with scale and a fair amount of growth opportunity would be able to get customers back into the restaurant. And then as they grew and got that scale that we just talked about, they would grow their earnings power value. So I think that all he did was bet on return of the earnings power value. And I think it was a great bet. It was very insightful and controversial for sure, not clear. I know a lot of people at the time thought that the foodborne virus would really keep customers away for a long time. And I think what Bill said is no, they'll be able to bring them back in. And this is inherently a scale business. And I've got a great management team. And I think that was the simple bet. I give him tremendous credit. Now, there is another layer of value that we have to look at, which we will in a minute. So he really drove his investment. What really drove his investment is that earnings power value, which in 15 was 4.8 billion, is now $16 billion. So it's increased by fourfold in 8 years. That's impressive. And you got to give a lot of credit to the management team for sure. But I think what Bill really saw was a scale business that, and I think he got it, that it was a scale business. As they grew, they would reap that scale. And he had a great management team and inherently a very good business. Very good call. All right, so what are the transactions? This is the actual share count that he bought. This is based on the old, I think this is the new share count. But he made most of his investment, almost all of his investment in 16. And the earning power value, the bet he made, increased by 900% over the next 8 years. Very impressive. Now, here's your market implied value growth. That layers on top of it. And this is your market implied value growth by itself. See, this is stacked with the earnings power value, but I want to look at it separately. What did the market implied value growth do over that same period? So earnings power value increased by a little over 9 times, and this increased by 10 times. So it slightly expanded. But what's really cool is if you look at market implied value growth as a percent of the enterprise value, which is really amazing, it's actually not changed much. It's been incredibly steady the whole time he's owned the stock. So unlike Apple, those of you who were on the Apple call, the market implied value growth of Apple has increased dramatically. In fact, the earnings power value at Apple has not done much in the last 4 years. And the only time earnings power value at Apple grew was in COVID as people upgraded their systems. This is just the opposite. Let me go back. Your earnings power value has increased dramatically through execution and a terrific business model, whereas your market implied value growth as a percentage has stayed, I don't know, this is relatively constant over the period. So what really drove it was that operating performance, and I think he nailed that. And then I guess the assumption is that the market implied value growth would hold, and it did, which is really pretty cool. Now, again, a longer lecture, which we'll talk about a bit in the program, is you can tease out the implied long-term NOPAT growth rate from these tools. There's your formula. The market implied NOPAT growth rate is just market implied value of growth as a percentage. That's that chart times your discount rate. And right now, the market implied growth for Chipotle, the long-term growth rate is 8%. And that's been fairly consistent over the last few years. But we can use that value when we look at the company, which is important. There's your growth rate isolated. And as you can see, during most of the time that Bill's owned it, the implied growth rate has really not changed much. It's been about 8%. It's come down a tad bit recently. We'll talk about recent performance in a few minutes. So what drove the stock was a performance of the company, not the PE didn't go up, the bet on the duration didn't go up, the growth rate stayed fairly, implied growth rate stayed fairly constant. It was just an execution on the business model. I think that's what Pershing Square saw, and you got to tip their hat. They nailed it on this one. All right, here's something that's interesting is that other than a small purchase in 2001, basically it's been selling his position off a bit every year. since he's owned it. And in a moment, I'll tell you what I think is going on. So there's his cumulative holdings in share count. And you can see that he got to 144 million shares. And now he is a small percentage of that. So he's sold off on a very consistent basis. Those are his sales. But what's kind of fascinating is that the dollar amount of the position has stayed somewhat consistent. And so I think that his trimming has been probably more of a portfolio level decision as opposed to a fundamental decision. Certainly, as you manage a portfolio, you've got to manage the size of the position, not just the performance. So when you look at the position value in this lens, looks like he's actually, when he's been selling, it's to manage the size of the bet, not a fundamental call on the company. I would just be fascinated if he had just held on to his original position, how much it would be worth. A lot more, that's for sure. And then there's the capital flows that he's gotten from his selling. And so you can see that he's taking money out of the position on a fairly consistent basis. But I think to maintain the position size about the same amount in dollars. All right, now, if Chipotle was to grow at 8% per year for 25 years, you'd have revenues in 2049 of $79 billion, $75 billion. I doubt that will happen. So that growth rate will slow at some point, and naturally as they get more mature. And I think that's the call. It's a great business. Profitability is back to peak. We lost the management team. Maybe the new guys are even better than Nichols. Hard to make that call. But at some point, growth rate will start to slow. And the challenge that I think for Chipotle in making the call now is you've got to look at total available market, which we'll talk a little bit about in a minute, and you've got the growth rate as we get there, which will be interesting. All right, so market implied value, earnings power value over the last 6 years has averaged about 15%. I just want to use that as a quick tool. So this is the market implied value growth at 85% if we use 15%. So that's what you're paying for. It's really important to understand that's what you're paying for. Now, if in fact that market implied value growth went from 85% to 60%, you would, the stock would go down by 25%, offset by any kind of growth. So I just want to show the sensitivity to this growth. And by the way, that equals a 6% annual implied growth rate. So if in fact investors said, right now they think that Chipotle can grow at 8%, but if they start to say, look, we really only think they can grow at 6%, that market implied value growth is going to shrink by 25%. And I think that's really important to keep in mind. If it declined, the market implied value growth declined to 50%, then the stock would be down 35%. That's a 5% annual growth rate. So this thing is incredibly sensitive to growth, as you'll see throughout the rest of the slides. And then I just threw this in, if market implied value growth went to 25%, stock's down 60%, that's 2.5% annual growth rate. Now, I'm not forecasting any of those outcomes. All I'm saying is that if growth expectations start to shrink at all, this market implied value growth as a percentage is going to come down, and that's going to be a real headwind on the stock, and it's really important to think about. And if it went away completely, the stock would be down 85%, which is important. All right, here's the S&P 500 quarterly earnings. Here's the S&P 500 earnings power value. It's right around 36% of the enterprise value is the earnings power value, which means that, that's the same chart, which means that the market implied value growth for the S&P 500 is 64%. And so at some point, if Chipotle were to slow its annual growth, it probably trades in line with the S&P 500. I was just sort of curious what that would be. Same chart, just another version of it. All right, so today, Chipotle's earnings power value is 20%. If in 7 or 10 years it traded in line with the S&P 500, that would be roughly 60%, and it would be a 6% growth rate. So if you think that Chipotle is going to trade in line with the S&P 500 in the next 7 years, you're effectively think that their annual growth rate would be 6%. What's implied by the current valuation is 8%. So if they grew 6% and the stock traded in line, they'd have to grow 6% to get there. Just sort of as a reference point, I think, yeah, 6.8% is the implied compounding. Okay, great. So let's talk a little bit about Chipotle and its growth. Now, how do they grow? They open new restaurants, and then revenue per restaurant is the two big drivers. So this is Chipotle's new restaurant count over the last couple of years. They seem to open the most restaurants in the fourth quarter. So when they report the fourth quarter, we'll see that. They're at 3,658 restaurants at the end of, there's a typo at the end of the third quarter. All right. Now, when you go look at the breakdown, however, what you're starting to see is red is the numbers are shrinking sequentially, and green is they're expanding. So it just gives you a visual. Comp store sales in the most recent quarter were disappointing, and that was 6%. In the second quarter, the summer is always good for them. It was 11%. In the March quarter, it was 7%. So after having a fairly steady growth, we've gotten to be a bit choppy, and I think that's what's really driving the stock. Right below that yellow band of comp sales is we have comp transactions, comparable transactions and price mix. And you can see that we saw a fairly dramatic slowdown in comparable transactions at 3.3%, and your price mix really helped. So they're benefiting from the tail end of the inflation boom. And you can just see that inflation or that price has actually become important in the last 3 quarters. You really want to watch that comparable transaction because that's really what's going to drive it. Now, remember that the stock price is implying 8% growth, and your comp sales in the most recent quarter were 6%, below that 8%. In the March quarter, they were also below that 8%. So whenever they're below that 8%, that's going to cause the stock to pause. And when they are above that 8%, it's going to generally help the stock increase. So by using the tools, teasing out what the implied growth rate is, and then looking at the quarterly growth rates, you actually have a tool to really compare, which I think is pretty cool. In the first quarter of 23, I just want to give you, they reported a 17% increase, which kind of drove the stock big. So that was a year ago, a little over a year ago, almost 2 years ago. And then later in the second quarter, they reported a deceleration, and that drove the stock down. So I just show these just to show that Chipotle is highly sensitive at this point, given its valuation, to that growth rate. You're going to have to monitor those growth rates pretty closely. That's really going to be the challenge. And then in the most recent quarter, I would argue it was a bit disappointing. And then that you see is disappointment as well. So the focus, when you use the Italian cookie, it shows you that growth is the most important driver. Current performance influences investor expectations for growth. So I'm not saying you ignore that, but growth really becomes the critical driver. There's your quarterly revenue per average number of restaurants. You can just see, when Bill bought in, it had been crushed by the norovirus, and they've been able to drive that to 838,000 per quarter. I'm going to look at an annual number in a minute. But this quarter was disappointing on a per revenue basis. They've had other disappointing. It doesn't mean they won't snap back, but there's no question that that was a bit of a disappointment quarter. All right, so that works out to just over $3 million per restaurant per year. We'll use that. The non-digital, if you look at the digital sales, they have been fairly flat for a while. They are decelerating pretty significantly year over year, down sequentially. That's digital. Digital is all the online stuff where you go and either have it delivered or picked up. So this has really been driven by what we call non-digital or in-store purchases. And you can see they were really quite impressive up until the second quarter. Year over year, it was 11, 17, almost 20, 23. That's what was driving the stock. And then in the quarter, they were down sequentially for the first time in 2 years, and you saw real deceleration year over year, which is key. All right, here's just the chart with all three of those, digital, in-person, and your total revenues. Exactly what we've been talking about. Now we can do some base rates. So this, I'm going to compare Chipotle to other quick serve restaurants. This is just the top, technically the top 10, but it comes from a list of the top 50, just ranked by total sales. So at 11 million, that's their, I'm sorry, $11 billion in revenue. That's their LTM. That puts them right in the camp of Subway's, Dunkin', Wendy's, Taco Bell, Chick-fil-A, Starbucks. Now, all of the companies that are near and dear them and higher than them are fast food restaurants. So this is the largest quick serve, I'm sorry, the largest fast casual restaurant. So I'm not saying they can't grow, but it's just a reminder that the food companies that are above them in total revenues are all fast food, not fast casual. So just important base rates. Now, if you look at it at revenue per restaurant per year, they're at just over 3 million. You have In-N-Out kind of right under them. Panera, by the way, is a comp, an important comp, but everybody above them is, in fact, also fast food. My favorite is Chick-fil-A. They top it at 6.7 million per unit, per restaurant per year, and they're not open on Sundays. So that's amazing. In-N-Out Burger, great burger shops in Southern California. Regional economies of scale, by the way. All right, in the most recent quarter, at the end, they had, oh, that's an old number, I'm sorry, but we know that they have 3,600 restaurants at the moment. Just to put that in reference, above them again, Kentucky Fried Chicken, Little Caesars, Dairy Queen, Wendy's. So they have done an amazing job for sure, but you just want to be sensitive to some degree about how much growth opportunity they have going forward. All right, what's critical, just to put this into perspective, this is indexed back to 2017, and it's the source of growth. So you have total revenue is up 268% versus its original. But that's really been driven, revenue per restaurant has been more important than restaurant count. And the revenue per restaurant is something you really would have to, you're gonna have to get very comfortable with in your growth, because that's been the most important driver over the last 5 or 6 years for sure. And if you thought that was gonna top out at some point, they've done an amazing job, then the only real driver would be restaurant count, which I want to talk about specifically. All right, the company has said that that's the correct number, but the date is wrong. Sorry, 2 edits, I apologize. Company has said that their target is 7,000 restaurants, which would put them up with Domino's and Burger King, Taco Bell, Pizza Hut, Wendy's, something that we're thinking about. It's essentially a doubling of the number of Chipotles to get to 7,000. So I did this analysis a few years ago. They no longer provide the core data, so I haven't been able to update it, but it'll give you sort of a methodology on how you want to think about it. This, at the end of 2019, this is the last time they reported the data in their 10K. I'm gonna put it on this map and just see. And then what I did is went through, and I'm not gonna go into too much detail on this because it's kind of in the weeds, but what I did is the number of restaurants per state, that's the highlighted column, that's what they give you. I then went and looked at population per state, and then you can create population per restaurant. Now, technically you would do restaurant per population, but it gets a weird decimal, so I do it the opposite. That's your population per restaurant. And then, I then force ranked them so that I had the lowest population per restaurant. That's the highest density. I thought it was surprising. The highest density is Ohio and Maryland. Colorado makes sense. That's their home base. But some of these I just thought were crazy. Virginia, they have the highest density. So I just was playing with this at one point, and I said, if you just take the average of the top 6, you could take the average of the top 10, you could take the average of the top 5. I just happened to pick 6. because the numbers were fairly close. And then that gave me a density number, a target, and then you can calculate an implied restaurant count. You do some things. And I come up with, if you kind of look at the whole country, you have the density of Maryland or Colorado, you end up with about 4,500 implied restaurants. And so, I'm not saying this is the definitive word, but this gives you a methodology how you can think about it. And then I went and looked at the country overall, and I came up with another way of thinking about it is 4,000. So, if you go look at historical densities for Chipotle, it looks like, 4,000, 4,500 is a reasonable target, which is a lot fewer than the 7,000. So I did say, by the way, is if you hit 7,000 restaurants in the country, that would be 47,000 citizens per restaurant, which compared to would be every state would have more density than Ohio has right now. So I don't know, the 7,000 seems like kind of a stretch, but this has been a company that's done a lot of things first. And so in that case, very, very impressive. So I don't know, looks like maximum maybe 4,500, which will put you right in there with Dairy Queen and Wendy's. I don't know, seems like a lot, but that's certainly going to be kind of the key, is that you can get there. All right. What drives the stock higher? Well, they have to beat the 8%. What's priced in is 8% a year, 8% NOPAT growth. So you've got to drive the stock higher, they've got to grow faster than the 8%. You're paying for 8%, they have to grow faster than that. So they grow faster than expectations. The other one is that you could have a greater growth premium. So either higher expectations, frankly, that's what's driven Apple all these years, or just grow faster than expectations, one or the other. And the key here is if the market implied value growth stays constant, which it has now for, pretty constant, other than maybe a little bit in COVID, for 8 years, if that stays constant, then you're going to have to grow earnings faster than expectation, which means you're going to have to grow faster than 8%. So 8% is truly your organic growth rate that you have to show. You could have the market implied value growth can expand. We've seen that at Apple, and it can contract over time. All right, so that's kind of let me go back here. That's kind of the end that I wanted to talk about. The key to these companies is growing NOPAT while maintaining the return on capital. So if return on capital starts to shrink as they grow earnings, that's not going to be great for the company. So what you're betting on right now is a long-term growth rate of 8% and a return on capital that stays fairly constant. Certainly what Bill saw in 16, you got to tip your hat, one of the great calls. He really thought, I think he really recognized that it was a scale business, had nothing to do with brand, everything to do with scale. As they reach scale, they'd be able to get back to their old profitability. I think he had a good sense that there was a lot of market opportunity, and you had a great management team. Most of those things are known today and priced in. Bill continues to maintain about the same dollar amount in his investment, and you have a new management team. All right, I'm happy to take questions. We technically have a 1 o'clock stop, but I'll take questions until we run out of questions.
All right, thank you, Paul, for the great overview, and it's definitely been thought-provoking, and it's generated some questions, which we'd be happy to go through. So maybe the first one would just be kind of a definitional question, and that is, can we just revisit for the audience how we get to or calculate earnings power value, and then also, as a follow-up, how we get to the present value of competitive advantage?
Absolutely. Now, I will give you the answer, but I could be a really, if I was better at sales and marketing, I would say, well, join the program, and we'll just, but I won't. All right, earnings power value. Conceptually, what's earning power value? And then I will give you the formula, which is shockingly simple. Earnings power value, my definition, is a little bit different than Graham's definition, and certainly different than Bruce Greenwald's definition, but it's the one I live with and the one I like. Earnings power value is steady state, no growth earnings power. So what does that mean? The company earns the same amount of money, roughly. They don't have to be exactly the same, but roughly the same amount of money every year forever. What would you pay for that? That's the definition. Now, the formula is easy. If a bond or a company or an asset earns the same amount every year forever, you can use the perpetuity valuation formula, which is just take the level of cash flows and divide it by your discount rate. So in Chipotle, I just take the most recent NOPAT. I assume that that's going to last forever. And then I use 10% cost of capital for all my companies, which is a longer discussion. If you want, ask that question why. So if you take the most recent NOPAT, divide it by 10%, that's your earnings power value. Now, those earnings are made up of two cash flows. One, which is just a return on capital adequate to support your invested capital. I'll explain what that means. And then excess returns. Excess returns are any returns above your cost of capital. So in this case, they're earning 23%. Their cost of capital is 10%. That spread is 13%. What is the value of those cash flows? Because earnings power value has excess returns and normal returns. The normal returns are definitely should be steady state. The excess returns are going to attract competition, and the competitors are going to try to go after those excess returns. So that excess returns, the value of those excess returns is effectively driven by their competitive advantage. So you're essentially, that light blue layer is the present value of competitive advantage. It's those cash flows that we think will last forever because we believe the company will maintain its competitive advantage. If that competitive advantage goes away over time, that layer of cash flow will go away. The value of that cash flow will go away, and that light blue sliver will certainly shrink and maybe disappear. So that's that first one. So earnings power value is just steady state, no growth. Take your NOPAT, your best estimate for a steady state, no growth NOPAT, divide by your cost of capital. I use 10%, make life easy. That's your earnings power value. Subtract off of that your invested capital, and that difference is driven by the cash flows created by excess returns, which is effectively a function of competitive advantage. Value those, and we call that the present value of competitive advantage because the assumption in that value is that the company's competitive advantage will hold. So those are those layers. Now, Andrew, did he also talk about market implied value of growth or no?
Not in those specific questions, but we've got a few other ones actually. Maybe I'll just lift these ones in chronological order. One question, we've had a few on Chipotle itself, and so maybe it could be a good time to talk about a couple of other things that are going on at Chipotle and how those might factor into the analysis. So the first question that came up was, what about international expansion as an opportunity for Chipotle? Maybe let's tackle that one first.
Yeah, let me ask you a question. I'll do it rhetorical because you can't answer, and then I'll answer it, which is, what is their competitive advantage? Their competitive advantage is scale, a little bit of customer captivity. All right, if you go international, what don't you have? Scale. So I'd be willing to bet serious money that it's going to be very hard for them to gin up enough business outside the US that business is got a return on capital anywhere near the corporate average, which means that as they grow international, it's going to bring the overall blend down, and investors are not going to like that. So global in general is a dumb idea. And you go outside the US and go look at Shake Shack. Shake Shack has shacks all over the world. And what's their return on capital? About 6%. So Chipotle, it sounds good from a growth perspective. It's terrible from a return on capital perspective. So you can't have it both ways. If they're going to open enough Shake Shack, if they're going to open enough Chipotles outside the US to drive growth, which is what people want, you're not going to be able to get the returns on that investment, and that's going to affect it. So you can have growth or returns, but not both. And so, no, sorry, it doesn't work that way.
Got it. There's a related question. Now, this is something Chipotle can do, I guess, with their scale, but the question goes, are the new Chipotlanes a new competitive advantage, giving a fast casual restaurant a fast food capability for throughput?
Yeah, I don't know. I'm probably mixed on this. They keep opening these up. It's certainly a convenience for people. It's 100% cannibal. It's certainly, most of it's cannibalization because people are going to drive through rather than necessarily park. Now, is it easier that way? Yeah, a bit. They've been opening them fairly fast and their growth rate's actually not accelerated. So there's enough of them now that if it really was it's not a competitive advantage. It might just lower the cost to the user effectively. Because if you think about it, I got to park, go into the restaurant, and if I can drive through, it's lowering my cost of acquisition. There are enough of them now. I think you'd see it in the growth rate or inverted. If in fact they've affected the growth rate, take that out. That means that the traditional business is actually growing less fast. So it's not a competitive advantage. It could drive TAM, total available market, but you should see it already.
Got it. And then since you mentioned it, uh, we had a question actually on Chipotle's growth and potential for self-cannibalization in pursuit of store growth, as has happened with some other companies out there. What are your thoughts there?
I think that's one of the most important things you have to look at. It's going to be noisy, meaning the numbers are not going to be perfect, but that's why I track that revenue per store or restaurant. I always call them stores. That revenue per restaurant per day is kind of what I look at. That dipped this quarter. It's noisy in that you can have a quarter where it goes one way or the other, but I think that statistic's incredibly important because if they're really going to drive to 7,000 restaurants, I don't think they'll ever get there, frankly. If they're going to drive to 7,000 restaurants, at some point, you really have to worry about cannibalization, which ironically is the Starbucks problem, which Nichols is going to go clean up.
Yeah, that actually did come up. And it may also be that Nickel left to be part of an international growth story, i.e. Starbucks. Um, we had we actually did have a question on market implied value of NOPAT growth. Could you go through again how that's calculated?
Sure. All right. So if earnings power value is steady state, no growth value, that earnings power value is the bet that the company will make this amount of money every year forever. What would you pay for that? Well, it's a perpetuity. You can use the perpetuity valuation formula. Easy, easy. So earnings power value is very straightforward. Enterprise value, we know, is the current value of all future cash flows. Why do we know that? Because it's straightforward, basic finance. All right, so then there's this gap for almost every company, public company, almost every, not every, almost every, there's a gap between enterprise value and earnings power value. My question is, what is that? What is that gap, that difference? Well, if enterprise value is investors' estimate of the value of all future cash flows, we know that to be true. Earnings power value is the value of a steady state, no growth cash flows. The difference has to be investors' expectations for growth in cash flows. By definition, I don't know what else the gap could be. And so that's your market implied because we take it from a current set of a current valuation, which is a set of investor expectations. So it's market implied. It's got to be growth because that's the only thing that could fill in the gap between earnings power value and enterprise value. So market implied value of growth.
Got it. And then actually, we as a follow-up to that, we had a question, which is, would there be a relationship between the market implied NOPAT growth of 8% and with comp sales growth of 6%? Is there a way to think about that?
Yes. I'm glad somebody brought that up because when I was saying it, I was like, we should go into more detail. The problem is that not every slide, but a lot of the slides have like a 20-minute lecture behind them, and I had an hour. Yes. The 8% is they're going to grow 8% forever. The 6% is that you think that they're going to trade in line. If they grow at 6%, ultimately they're going to trade in line with the S&P. There's a bit more detail here, hard to explain very quickly, but they're essentially two different time horizons.
Got it. And then we had kind of a mechanical question. It came up from a few different askers, and that one is about using the 10% WACC here and just kind of the thinking there, why hold the cost of capital at 10% for every company? Wouldn't that overlook the risk of business?
Well, look, I've got like 9 different reasons. So I'll give you a couple. All right, number one, I know I'm going to give you the story I always tell. You guys asked, you have to listen to this story. Go to any great investor, and ask them to do the following, just reminiscence down memory lane. Say, think of the 5 best investments you've ever made in your career, or in the last couple of years, doesn't matter. And give them a moment to savor in that, oh my God, this one, I am such a brilliant investor. Okay, done. You've got 5 in your head. Great. Now I want you to do something sort of the opposite. Think about the 5 worst investments you've ever made. And then they're going to, as they go through it. All right, so you have 5 great, 5 terrible, you have 10. Now, of those 10, tell me which of the 10, the outcome of the investment rests on the discount rate you used. None of them. The 5 best had nothing to do with the discount rate. You got the cash flows right. The 5 worst had nothing to do with the discount rate. You got the cash flows wrong. So I just stop and I think, wait, why do we spend so much time on discount rate when it really doesn't matter? That's the first order. The second order is no one knows what the number is. So that's for sure. We know it's higher than the cost of debt. That we know for sure. How much higher? I don't know. So, you got to pick a number. You don't have precision. The formulas you're given in business school are wrong on so many levels. They're wrong. So I don't have a formula. Beta is ridiculous. I know it's higher than the cost of debt. And at the end of the day, it's not the most important factor. Use 10. It makes the math easy. My dear friend, Robert Hagstrom, and I were talking a couple of years ago. We got talking about this very topic. And it was in the middle of somewhat near the end of COVID, and rates on we got the 30-year down to 6%. And we were talking, and he said, what do you use as a discount rate? And I said, well, Robert, for years and years, I used 10, and I'm sort of using 8 right now because the long rate is down to 6, and I don't know. And he chuckled a little bit. And I said, well, wait, why are you laughing? And he said, because that's what Buffett's done. He used 10 up until the recent period, and now he's using 8. I suspect that Buffett's back to 10. And so to steal that great line from Iron Man, Tony Stark says, if it's good enough for Dad, it's good enough for me. So that's why I use 10. Really? I mean, and by the way, if you look through this, use 8 and nothing changes. I mean, the numbers change a little bit, but the analysis doesn't change. So if you're going to spend a lot of time trying to figure out the discount rate, God bless you. Now, in bonds, maybe. In some sort of project finance, perhaps. In equities, don't waste your time.
Got it. And then maybe actually just following up on the good enough, if Chipotle's got 80% attributed to market implied value growth, is this too high for your liking, or where do you like that ratio to be as part of an investment decision?
Well, if you really, to me, value investing is not overpaying for growth. I mean, end of story. That's to me value investing. Don't overpay for growth, long-term growth. Now, there's another lecture here, which is you can pay for that growth as Bill did. He paid for the growth and they crushed it, but that's still not overpaying. So your question is 80% too much? Well, it depends on the company and the opportunity. As you saw in Chipotle, it stayed at 80% now for 8 years. So no, it's never been too high, but they've also crushed it on growth. Now, let me just give a quick caveat. This is NOPAT growth. Now, NOPAT growth is a function of revenue growth and margins. So if I grow my revenues at 6, my revenue's at 6, but I can increase my margins and I can get a 10% NOPAT growth because of it. That works. Now, at some point, you can't keep increasing your margins. Now, what Chipotle did is they did it through scale, a little bit of pricing. So, is 80% too much? Math works easy. That's about 8%. No, if the company can grow faster than that, that's not too much. It's all about that, but you're paying for that. You're paying for that 80%. I think Chipotle, the challenge for Chipotle is there's probably no more margin expansion, maybe a little bit with price, probably not much from scale. So it's going to be restaurant growth. And I think it's going to be tough to grow restaurants fast enough over the next 4 or 5 years. I'm not making a call on 2025, but I think over time that's going to be increasingly difficult because you don't have the margin to help you out.
Got it. And then actually, here's kind of a question about, it's a meta question, but how long does it take you to do an analysis like this? Do you have a checklist that you follow to produce something like this? I think inquiring minds want to know. Maybe there's a course where they can learn about this.
Yeah. No, here's the sad truth. The analysis takes no time. Really, the analysis. Putting the presentation together takes forever. The analysis, I have it built. Take the course. I'm giving the template away in the course. There's an incentive. You get a copy of the core template for what it's worth. Updating these and doing a company scratch for the first time. I'm old school. I like to put the numbers in by hand because I want to see the numbers. I want to literally type the numbers in. But Paul Sonkin, my co-author and very dear friend, he's programmed this into CapIQ. And so it takes him 45 seconds to build a model or something like, maybe less. He types in the symbol and it populates. So you can actually do this to the point where it's unbelievably easy. I have all the charts linked, so they just populate instantly. The most I spend is when I actually have to add a column. So the analysis itself, even if I'm starting scratch, it's simple, straightforward. If I start from scratch, I can have a company up and running in a couple hours. These charts, these beautiful, incredibly handcrafted charts that I presented take forever to update, but that's fun. I don't mind that.
We've got an aside from actually your near dear friend Robert Hagstrom, who writes, "Hey Paul, great webinar. Just a reminder, if you were to ask Warren Buffett what caused his most mistakes, what caused failure, he would tell you the mistakes he made in forecasting the competitive advantage period and how long the cash flow growth would last." So there we have it, chiming in.
Thank you, Robert. I appreciate that. That's excellent. Yeah, I'm going to riff on that for a second because Robert and I have talked about that. And I do, in the program, I interview Robert, and it's absolutely a fabulous interview. I don't know. I took 3 pages of notes and interviewed him. I don't know how I did that. So if you want to take the program, you get a chance to. Robert has some fabulous stories and amazing insight. And what he and I were talking about, that if you go ask Buffett, he would say that his biggest challenge, mistake he's made, is estimating the duration of the competitive advantage. And I think if you're a longer term investor, I think that's really important. That's probably more important, frankly, than growth, because growth is such a function of that competitive advantage. And Robert's been working on some stuff which he calls long horizon arbitrage, which is if you own these high return companies and they deliver, you just make a ton of money and you don't have to do anything. Your broker gets poor because you don't trade. And you just sit back and watch, and it's just amazing. Now you got to get the business economics right, but I think he's absolutely right.
And so we have another question, which is actually on competitive advantage and durability. What do you think about the durability of the types of competitive advantages of Chipotle, scale and consumer captivity?
Yeah, the buzz in the back is my Chipotle order arriving. That's just a joke.
Jamming the comp sales.
Yeah. No, that's welcoming, Eric. The buzzer's always buzzy. Well, there's a whole lecture in the program on competitive advantage. This is something I've spent 30 years thinking about. And it's finally, I like to say that after 30 years, I think I got it. I think that Chipotle, in a sense, has the perfect competitive advantage. Now, I think the issue with Chipotle is growth and total available market. But to me, the most durable competitive advantages have 3 components. Some level of customer captivity. I was talking to Michael Movison the other day. He's also interviewed in the program, an absolutely wonderful interview as well. And we got talking about this willingness to pay. And you think about those products in your life that you're just delighted with. That means you have a high willingness to pay. And I think Chipotle, I don't know that they have a ton of pricing power in the sense that they can keep raising prices every year because they have competitors, but they have a very high willingness to pay. People are delighted with the product. So you get the customer captivity from that willingness to pay, which is high, and then scale. And those are both of those are hard to replicate. And the combination of economics of scale and just to go back to Chipotle, they have two primary sources of scale. One is, remember, they're delivering fresh food every day into the restaurant to be cooked for the customer, cooked or prepared. And the more density you have of restaurants, the better scale you have in distribution. The second source of competitive scale is marketing. And they can advertise pretty aggressively because spread over the number of restaurants, it's actually not very much money per restaurant, but they have enough restaurants that they can aggregate it. So this customer captivity and then the economic benefit of scale, I think, is the ultimate competitive advantage. I said there were three pieces. The third piece is management vigilance, one of my favorite words, vigilance. Management that understands their core competitive advantage and does everything they can to protect it. And I would argue that the guys at Chipotle understood that. So that, to me, I wouldn't spend a lot of time worried about Chipotle's competitive advantage. I'd spend all your time worried about is how big is this market? How many restaurants can they open?
Got it. Well, we're kind of getting the blinking, flashing light from the good folks at Wall Street Prep. We may need to put a pin in it there. It's been a great webinar. We're getting a number of questions still asking about whether there will be a recording sent out. The answer is yes, there will. More content like this is available in the Applied Value Investing Certificate Program offered through Wharton and Wall Street Prep. I'm going to drop a link in the chat here just as a follow-up. So let me just put this, and that's we look forward to welcoming you to the program of those who join. Any closing remarks, Paul?
No, I love it. This is something that Andrew and I and Brett, the Wall Street Prep people, the Wharton people, David Musto and Nikolai Fidjikow, I pronounce his name.
Fidjikow.
Yeah, are very passionate about bringing these tools to investors. As you see, we've all dedicated a ton of time to bring you the best content. We're very proud of the program. Love to have people in the program. The more, the merrier. And have access to these tools. But thank you all for listening and giving me an hour and 15 minutes of your day.
All right. Thank you very much, everybody, and hope to welcome you to the program soon.
All right,